Good morning. So we're in Chapter 10, Section 5, Life Insurance. And I'll highlight a few things here. What are the advantages of purchasing life insurance? Well, first of all, what is it? Life insurance provides cash benefits to a beneficiary or somebody you choose whose name's on the policy. It can help pay for funeral costs, lawyers' fees, outstanding loans, mortgages, other living expenses that dependents might not be able to afford after the death of an income provider. So a lot of times people get life insurance after buying their first home so that it gets paid for in the case of them passing away. A life insurance premium, remember we used that word premium before, is the amount you pay for the policy when we were talking about cars. Premiums can be based on many factors. One is the age of the policy holder. So for each age group, the insurance company estimates the number of people expected to die and the number of years that the remainder of the people will live. Pretty dark. These facts are used to calculate a death rate for males and females in each age group. The computations are done by statisticians who work for the insurance companies, and those statisticians are people that we call actuaries. You might have heard that term, actuaries, but statisticians that work on this kind of probability stuff are called actuaries. Death rates are listed in a mortality table. The death rate for a person's age group is a key element in determining the premium and is called the mortality rate. People with a higher probability of death in the near future pay higher insurance premiums. Insurance premiums are also based on the amount of coverage you purchase and the type of policy you buy. And the amount of coverage that a policy provides is called the face value of the policy. There's 4 types. There's going to be the term life, a level term insurance, permanent life, and whole life insurance. There's universal life insurance and variable. Make sure you read all of those because we're going to do another one of those vocabulary quizzes, and the answers are going to be in the reading part of each of the sections. But for now, let's get to the examples. Jack is 40 years old. In 10 years, his house will be paid off and his daughter will have completed college. He wants to take out a 10-year life insurance policy with a face value of $750,000. The monthly premium is $76. What will be Jack's total cost over the 10-year period? Well, you pay per month. So 10 years, 12 months per year, $76 per month. Over those 10 years, it's going to cost Jack $9,120. If within any period of that 10 years he dies, his daughter gets $750,000. But within that, but after 10 years, if he's still alive, then the policy just goes away. Logan purchased a whole life policy with a face value of $100,000 when he was 28 years old. The annual premium was C dollars. That's what he paid. He wanted to increase the face value to $250,000, so he had to apply for a new policy. Since his current age was higher and he had some health issues, the premium increased to X dollars. So express the percent increase algebraically. So the increase was X minus C, whatever the difference is between the new premium and the full premium. The percent increase is going to be that new premium, X minus C, that difference divided by C, the original cost. But you're going to end up, when you do that, getting a weird wonky decimal. So you got to times it by 100 so that you actually get the percent. So things to consider: age, health, family history, all go into how much you pay in premiums. So thinking about locking in your lower rate when you're younger and healthy is probably a pretty smart strategy. Gabriella's whole life premium increased from $123 to $166 per month when she increased the policy's face value. Find the percent increase to the nearest percent. So this is the previous problem, but now with numbers. So we're going to go 166 minus 123 divided by that 123, and it increased by, and it says to the whole nearest percent, so that's going to be 35%. 34 points if you're below around 75. Example 3. Mario had a universal life policy with a face value of $250,000. The current cash value of the policy is $8,260. If the premium is $97 per month, for how many months can the cash value be used to pay the premium? So these universal life policies, and you can go back and read about them, are kind of funny. But you can just stop paying, and whatever you save up will be used to pay the premiums. So here we go. That's going to be $8,260 divided by that 97 per month is 85.15. So mathematically, this can be represented by using the greatest integer function, which has its own notation. So when you have this, the greatest integer of a number x is the largest integer less than or equal to x. If a number is not an integer, the greatest integer of that number is the integer to the left on the number line. Here, let's highlight it yellow. Remember, it's the left on the number line. So in this case, the number of months, greatest number of payments he can make is 85. All right, next problem, example 4. Joe is an insurance agent. Zach, a 45-year-old man, who inquires about a life insurance policy. How can Joe, the agent, assess the risk his company is taking when they offer a life insurance policy to Zach? So Joe uses the mortality table for males. And this is sort of what something looks like. Created by insurance company actuaries. The death probability or the mortality rate is the probability that a man of a given age will die before his next birthday. So Zach is a 45-year-old man. We're talking right here. Zach's premium is going to be based off of the fact that 0.37%. So if I was to move the decimal, it's going to be a couple zeros in front, right? Just like you see over on the right. So 0.37% of men his age will die before they turn 46 years old. This indicates life expectancy. So that means if Zach is 45 years old, plus that 32.78, Zach is expected to live to be about 87, 88 years old. No, sorry, can't do math. 77, 78 years old. The mortality rate for a certain female who is old is 0.043. The company insures 7,000 people in this category, but how many of them will die before their next birthday? Super dark. So we'll take that number, 0.043 times the 7,000, and that is going to be so about 301 people could die before their next birthday. That's the probability. That's what these actuaries do. Example 5. The umbrella state insurance company sells a 5-year term insurance policy with a face value of $150,000 to a 41-year-old man for an annual premium of $648. What's the profit the company is going to receive from selling this policy for each age at death? So here's the thing. As long as a man's alive, alive, then for those 5 years, it's going to be 5 times, and since that's the annual premium, $648, and that's going to be, the company's going to realize $3,240 in profit over the next 5 years if the man stays alive. But if he dies anytime within that 5 years, let's pick a number. Let's say 3. So if after 3 years, the guy doesn't make it, then the insurance company is going to lose money. So it's going to be those 3 years of premium minus that $150,000 that needs to be paid out to the beneficiaries. So in this case, the company's going to lose $148,056. So you could do that for each year. Example 6. You witness that a company seems to take on a greater risk when they sell a policy. The mortality rates and amount of profit are shown in the table. If the company sold 10,000 of the same policies, what would their expected profit? So remember in geometry class, expected value problems with the spinners. This is going back to these kinds of problems. What would be the expected value for the 10,000 policies? So expected value, I'm going to add right here. We take the number, so what they could, their profit at the end of the year times the mortality rate, and we multiply those together. So if I multiply the negative 149,352 times that 0.0026, that's going to equal negative $388.31. For the next one, expected value, you take all the probabilities and add them together. So this is going to be a negative 431.24. To that you add, when you do the math, a negative 458 to To that you add negative 501.19, and to that you add a negative 543.01. But more than 46 years old, it's profit. So that is 3,240 times that, the 98%. So that mortality rate, if you added up all those numbers and subtracted from 1, that's where you get the 0.9843. And that, to that expected value, you add 3,189.13. So if you added up all the negative numbers and added it to the final positive number, you're going to have expected value is negative 2322.72 plus that 3,189.13. So what would their expected profit be for one policy owner? So per policy, profit, and this is all mathematical. This isn't like what really happens, but per policy profit, the actuaries estimate to be around $866.41 profit if their models go as they plan. But multiply that by 10,000 policies. So 10,000 times that 866.41. They sell 10,000 of these policies. And remember, insurance companies are in the business of making money. They should expect a profit of $8,664,100. But that's not just one guy sitting on a pile of cash. You have to pay for all your employees, and you have to pay for those statisticians to do that math anyway. So that money's spread out, but that's a good profit. Or at least I think it's a good profit. It depends on what everything else that they spend money on. But that's how we do it. Expected value. We take that assumed profit at the end of the year times that mortality rate. And then we're going to add up all those expected value numbers to get the policy per profit and then multiply it by the number. So we're going to have a few of these in homework.